Hey everyone, welcome back. We need to talk about silver, and I mean we really need to talk. What's happening right now is not just another market fluctuation or a temporary shortage. This is a seismic shift. The entire physical silver supply chain is being
Oh
taken over right
my.
before our eyes, and the next stop for the price could be numbers that will shock most people. We're talking about a potential move to $80 and beyond. So what's going on? Simply put, industrial giants are staging a hostile takeover of the physical silver market. While retail buyers are scrambling online trying to find a few ounces here and there from dealers who are increasingly sold out, massive corporations like Samsung, Tesla, and First Solar are going straight to the source. They're bypassing the entire retail distribution network and negotiating directly with the major Swiss refineries, the big names like Valcambi, Heraeus, and Argor Heraeus. And here's the kicker. They're not paying spot price, not even close. We have credible information that industrial buyers are paying as much as $82 per ounce for immediate delivery of physical silver. Let me repeat that. $82. This isn't a rumor about a coin shop charging a high premium. This is the price that industry is willing to pay right now to secure the metal they desperately need. Why are they doing this? It's simple economics. These companies have finally woken up to the fact that the so-called vaults are effectively empty. For them, the cost of shutting down a multi-billion-dollar factory because they can't get a few $1 million worth of silver is catastrophic. It's an unacceptable risk. So the price of silver has become secondary. The only thing that matters to them now is availability. This is why your favorite online bullion dealer is telling you that deliveries are delayed until April or even May of 2026. It's not a website glitch, it's not a temporary logistics problem, it's because their wholesalers are getting zero allocations. The refineries are selling 100% of their output directly to industrial clients. The normal supply chain structure used to be roughly a 60-40 split between industrial and retail investment demand. As of this week, that is shifted to 100% industrial, 0% retail. Think about it from the refinery's perspective. Would you rather deal with hundreds of small orders from wholesalers, negotiate premiums, and manage complex logistics? Or would you prefer to sell your entire inventory in one go to a massive corporate buyer who is willing to pay a huge premium and wire the cash immediately? It's a no-brainer for them. They're taking the path of least resistance and highest profit. The retail market has been completely cut out of the loop. Now, let's look at the COMEX, the paper market epicenter. The inventory collapse there is staggering. In just the last few days, the registered silver inventory, that's the silver available for immediate delivery against a futures contract, has plummeted from 28.3 million ounces to just 24.8 million ounces. That's a drain of 3.5 million ounces in under 4 trading days. We are seeing a burn rate of nearly 1 million ounces per day being pulled out of the COMEX. Do the math. At this rate, the registered inventory at the COMEX will hit zero in about 24 days. Zero. And it's not just the COMEX. Silver is being systematically pulled from ETFs and the London vaults as well. And here's the crucial part. Once this metal is moved into industrial inventories, it's gone for good. It gets consumed in solar panels, electric vehicles, and electronics. It never comes back to the investment market. So the big question is, with all this insane physical demand and the supply chain completely breaking down, why hasn't the paper price on your screen exploded yet? Why is it still hovering around $73? The answer lies in the derivatives market. There is a massive, and I mean massive, gamma wall built up at the $75 strike price for options. The big bullion banks have sold a huge number of call options at that $75 level, meaning they're on the hook for enormous losses if the price blows past it. To protect themselves, they're doing everything they can to keep the price below $75. But here's where it gets interesting. This is the exact same setup we saw in the legendary GameStop and Volkswagen short squeezes. As the price gets closer to that $75 strike, the banks who sold those options are forced to hedge their positions by buying silver futures. This is called delta hedging, but their buying activity pushes the price even higher, forcing them to buy even more futures in a vicious feedback loop. If and when the $75 level breaks, the gamma squeeze will ignite. The algorithms will take over and the price could surge with incredible speed, potentially hitting $85 or even higher in a matter of hours. The banks are absolutely terrified of this scenario. You can expect them to pull out all the stops to prevent it. Watch for tactics like spoofing, where they place huge, fake sell orders of 500 to 1,000 contracts at a time. These orders are designed to scare traders and trigger stop-loss orders, shaking out the weak hands before the real move happens. You can tell it's fake selling because the volume will be very low on the tape. Real selling pressure comes with high volume. What we have now is a two-market reality. There's the paper market, where banks and algorithms on the COMEX are desperately defending the $73 line in the sand. And then there's the physical market, the real world, where industry is paying $82 an ounce and draining every available bar from the system. This arbitrage gap, this difference between the paper price and the physical price, tells you the truth. The price on your screen is a lie. The real price of silver is what the most desperate buyer is willing to pay, and right now, that's $82. So, what does this mean for you? First, ignore the day-to-day volatility in the spot price. It's becoming increasingly irrelevant. The industrial bid of around $82 is the true price floor. Physical silver simply cannot be bought anywhere near the $71 or $73 paper price anymore. Instead of watching the spot price, watch the premiums. Rising premiums are the clearest signal that the physical shortage is getting worse. And my most important piece of guidance is this: if you already own physical silver, do not sell it. I repeat, do not sell it. Once you let go of your physical metal in this environment, you may find it impossible to buy it back at any reasonable price, if at all. Remember, as a retail investor, you are no longer just competing with other small buyers. You are now in direct competition with multi-billion-dollar corporations that have an insatiable and non-negotiable demand. Let me be clear, this is no longer a speculative theory. This is industrial resource warfare playing out in real time. Corporations are moving to secure their supply chains for the next 2 years or more, and they are willing to pay any price to do it. The $75 gamma wall is getting closer and closer to breaking. Once it does, the paper price will be forced to start reflecting the physical reality. The supply chain has been hijacked. Physical silver is becoming king, and it's not coming back. Prepare accordingly. Thanks for watching, and I'll see you next time.